What's up, my fellow wealth creators? Matty Guys here. In this video, we are going to have some fun breaking down and addressing some pretty wild claims about infinite banking and dividend paying whole life insurance, which, as you probably know by now, I'm a huge fan of. I've done tons of videos about my experience with infinite banking over the last a little over 3 years now. And guys, it's an incredibly powerful financial strategy. It has been an absolute game changer in my life. And actually not just my life, the lives of some of my friends and family as well. I've been able to use my policy, basically my own private banking system with these policies to help them consolidate their high interest credit card debt, which has put hundreds of dollars per month back into their pocket. Obviously, it's really good for their credit score as well. And it's hard to describe how gratifying that is to be able to help people that are close to me, with their personal finances, help them get back on their feet and just get into a better financial situation. And it doesn't really impact me at all. My money's continuing to grow in the policy. They pay back the policy loan and the interest on it every single month, but it's still put hundreds of dollars back into their pocket every single month. It's freed up a lot of cash flow for them. It's very, very gratifying. And not to mention how I use my policy in my own life for my wealth building journey. My primary use case is with real estate. I'm about to do my third real estate deal right now. So it's a phenomenal way to build wealth in multiple places at once and really accelerate the wealth building process. That's why when I see videos like this, it's really frustrating because we don't need to overhype this stuff. We certainly don't need to misrepresent it in order to get people to buy into it. Like again, just based on my experience, when you start to learn how this strategy works, when you start to understand all the benefits that you get from a high cash value dividend paying whole life insurance policy in order to implement something like infinite banking, you quickly realize that this thing is far superior to a lot of the things that we've been taught, when it comes to building wealth, right? With that said, it's certainly not for everybody. I think everybody should at least explore it, but it's definitely not for everybody. Everybody's situation is a little bit different, but we don't need to overhype this stuff, and some of the things that this gentleman says, there's a lot of half truths in this video, but some of them are just, some of these statements are just straight up false. They're just not correct at all. And that's one of the reasons why I started this channel, guys. One, to share my journey, my wealth building journey with you guys, and maybe give you guys some different ideas that maybe you weren't aware of before that can help benefit your wealth building journey as well. But also it's to present the facts and information that you need to make a truly informed decision, because you can't make an informed decision if you don't have the right information, right? And you'll see what I'm talking about when we break down this video, right? So let's get into it real quick though. I do want to give a shout out to Caleb Gilliams over at Better Wealth, because he did a breakdown of this video a little while ago. That's how I found out about it. And now I want to give my thoughts on it as well. The video is called how to become your own bank in 2025 and pay zero taxes legally. This is by Ben Oberg. And Ben, if you end up watching this and you want to have a conversation about this, then I am my door is open. I'm more than happy to do that with you. But unfortunately, I have an obligation to call out some of the incorrect statements that are made in this video so that people have the information they need to make a truly informed decision, because some of these things create wildly unrealistic expectations about what dividend paying whole life insurance can do. And when it doesn't meet those expectations, then people get pissed off. They make plans around those initial decisions that now they have to change those plans. And it gives the industry and the product a really bad rap, when in reality, the product is amazing when you know what you're doing with it, right? So let's get into it and have some fun.
How to become your own bank. Some people call it infinite banking, but I have to warn you, this is going to piss off every financial advisor that watches this, because I am going to walk over everything that you guys do, and I'm going to prove that what you guys do doesn't work and is inferior, and how much you do not know about finance and money.
Okay. So I wouldn't take it that far, but we're actually somewhat in agreement here, where again, this is all based on my experience, guys, with infinite banking. It is absolutely a far superior financial strategy than what we're normally taught to do when it comes to building wealth by the legacy system, the traditional financial playbook of go to school, get a job, get your promotions, stuff money into your 401k and tax qualified plans, create a diversified portfolio of mutual funds and bonds. And then by the time you're 65, 70 years old, you're going to be rich and you'll sail off into the sunset, live your golden years. That's not working out for a lot of people. When you look at the actual data, that is not working for a lot of people. It's pretty dismal, guys. All right. So I agree that infinite banking smokes the traditional financial playbook all day long when you know what you're doing and you do it right. Okay. With that said, I do believe there is a place for the traditional financial playbook, stuffing money into a 401k and then just crossing your fingers that you'll be rich in 30 years. There's an argument to be made that that is better than doing nothing. It's not as good. There are obviously much better options available to us, like infinite banking. However, not everybody's ready to, and not everybody wants to do something like infinite banking, because infinite banking requires you to take responsibility for your personal finances. It gives you back a lot of control of your money. For some people, that's not a good thing. A lot of people don't want to worry about what they're doing with their money, and in having a really strategic plan in place that they're implementing and stuff like that. That's not for everybody. Some people just want to, go do their job, do what they want to do, spend time with their family, etc., and just put money into the 401k, right? Not really worry about it. Have Wall Street manage it for them. And I'm not judging, okay? If that's what you want to do, as long as you understand the consequences of those decisions, and that by the time you're 65, 70 years old, it might not play out the way that you thought, okay? As long as you understand that and you're making conscious, intentional decisions, then you're an adult, do whatever you want, okay? So I guess my point is, while this is infinite banking far superior than traditional financial playbook, there is still a place for it. It all comes down to your individual situation, all right? So, but in general, Ben and I are in agreement that infinite banking is far superior to the traditional financial playbook. Here we go.
What's up, guys? This is Ben Oberg. Your not financial advice for today is how to become your own bank, or infinite banking. Some people call it that. And we're not going to use these inferior index universal life policies or these low-grade financial products that advisors sell you. We're going to use what they...
Yeah, and I just got to mention really quick, I can't believe I'm going to do this, but I'm actually going to defend IUL here in a minute, because he's going to provide some half-truths about IUL. He's not giving you the full story. And even though I am not a fan of IUL whatsoever, there's just way too many things that can be changed. There's too many things that can go wrong. You're injecting a lot more risk into the process because of all the things that can be changed, for the potential to earn maybe 1 or 2 percentage points above what you get in a whole life policy. To me, the risk reward is not there. With that said, I still think it's important that you have all of the information so you can make the best decision for yourself. But I am actually going to defend IUL here in a minute. But just know that infinite banking is traditionally done with dividend, overfunded, high cash value, dividend paying whole life insurance, not IULs, guys. All right, I've done plenty of videos on that. If you want me to send it to you, leave a comment down below and I'll send it, the specific reasons why you probably don't want to use IUL for infinite banking. Can you? Sure, you could try. But just because I can cross the street, here's the thing, before I get to the example. Just because you can do something doesn't mean you should. I can cross the street without looking both ways. Okay, but should I do that? No. One of these times I'm probably going to get run over. Okay, so just because you can do something doesn't mean you should. All right, keep that in mind. Here we go.
Very few people know about, and what is institutional grade, and I'm going to tell you how you can get access to it all in this video. And by the way, I'm not an advisor. I don't get paid to teach this shit to you. I just want to expose you to the real truth, and I'm actually going to show you advisors in a little bit arguing with me, saying that what I do doesn't actually exist. It does. I've been making a lot of money with it, and I'm going to tell you all of the steps that you can follow to do it, and the 4 specific steps that I use to become my own bank, lend capital myself, get 2 returns simultaneously, go into hard assets that cash flow, repeat the process, pay low taxes, and keep doing it over and over and over. All right.
So that's actually a good representation, a pretty good representation of infinite banking and the idea of like using the policies to actually build wealth, because there's a lot of different ways you can use the policy. You can self-finance large capital purchases, like buying a vehicle. You can consolidate credit card debt. But then there's the strategies of actually building wealth with it. So the bank part of it. So this is not a bank, guys. All right, we're using a financial product, dividend paying whole life insurance, similar to what we would go to a bank for. Like normally you go to a bank to get a car loan or get a loan to invest in real estate or something like that, right? Well, instead, we're redirecting where we save our money and store capital into these policies. And because we're able to borrow against these policies, we can now use that capital to acquire income producing assets, right? So we establish the banking system, right? And then we borrow against that money. We're building wealth in two places at once because the money in our policy is still getting that uninterrupted compound growth. But then over here, we're going to either acquire an income producing asset or take part in an income producing activity. One of the things I do is lend on real estate. So now I'm making money twice there. And the only thing it costs me is a little bit of simple interest in order to do that. So that's a pretty good overall representation of how this cycle of infinite banking works. And you repeat that cycle over and over and over again. All right, let's continue.
Guys, welcome to my channel. If you're brand new, if that wasn't subscription worthy, I don't know what is. Make sure to subscribe. We're dropping bombs about teaching you guys how to become your own bank, escape the modern financial system, and build wealth like an institutional grade investor. And I don't gatekeep. I tell you exactly what I'm doing, and I show you that we're doing it. First of all, what is infinite banking? It's this concept where you're basically lending capital to yourself with a tool that you acquire so that you can bank against your own assets and repeat the process. If that sounds confusing.
Kind of, yeah. So everybody has a different way of, I've seen that everybody has a different definition or a way of describing infinite banking. Mine, on like the surface level, would be infinite banking is a financial strategy that utilizes an overfunded, high cash value, dividend paying whole life insurance policy to grow, to earn uninterrupted compound growth for the rest of our lives, with massive tax advantages, while also being able to use the money at the same time for emergencies and wealth building opportunities without interrupting that compound growth. So everybody's definition is a little bit different, but kind of surface level there. I think we're pretty close on that.
I will explain in just a minute here. First of all, we got to debunk what the financial advice is that you have been told. A lot of advisors sell what's called an IUL or an index universal life policy so that you can infinitely bank. There's a couple problems with this. One, IULs have a hidden insurance cost that you don't get to know what it is. So when you're investing.
Okay, so this is the first. So this isn't even really a half truth. This is just incorrect because with pretty much every IUL illustration and policy, you're going to see a pretty in-depth, descriptive cost breakdown. Like you can see the cost inside of an IUL. And the reason for that is because a lot of those costs can change. They can be adjusted by the life insurance company in order to manage their risk, right? It's one of the main reasons that I want nothing to do with IUL, because there are so many factors outside of your control that the life insurance company can change that can have a negative impact on the long-term performance of the policy. But from a transparency standpoint, you can see the cost. Particularly the insurance cost, I'm pretty sure anyways. Nothing is hidden though. And it's because everything can change. So legally, they have to disclose these particular costs. And when it comes to insurance costs in an IUL, so an IUL is built on what's called annual renewable terms. So that insurance cost is going to go up every single year. Now, that doesn't mean that you're going to pay more every single year, because what you pay is based on what's called net amount at risk. All right. I've done other videos breaking that down. If you want me to send that to you, drop a comment down below. Just let me know. I'll send it. All right. Breaking down the difference between cost of insurance and net amount at risk. That's very important if you're considering an IUL, okay? But nothing is hidden in an IUL. And actually, you could make an argument that an IUL, when it comes to cost, is actually more transparent than a whole life policy, because there is no cost breakdown in a whole life policy. And so a lot of agents, particularly IUL agents, will say that that's a bad thing. That's why, IUL is so much better because it's more transparent. Well, no, not really. There's more to the story than that. All right. The reason, one of the reasons anyways, that we don't get as much of a cost or really any cost breakdown on a whole life illustration is because the costs are level. They can't change within throughout the life of the policy, right? They're locked in, right? Your mortality costs are level they're leveled out throughout the entire policy. There's nothing that changes inside of a whole life policy, okay? The only thing that can change is the dividend rate, whether they pay out a dividend and what that dividend rate is, okay? But they paid out dividends since inception. Dividend rates are going up right now, which is pretty sweet. But anyways, from a cost perspective, I don't really care to see, I don't need to see a cost breakdown. It's just, if you don't like what you see on the illustration, assuming you're illustrating conservatively, then just don't buy it. Don't get it. Then it's kind of like this. Here's the example I like to give with this. If I go to a car dealership and I see the car that I want to buy, I see the price tag and I know what it's going to cost me out the door. Do I need the car dealership to give me a full cost breakdown of that price Do I need to know what it costs them to make that car and import it and store it, what the commission's going to be? No, I just want the car. If I'm happy with the price, I'm happy with what I see, I just buy it, right? I don't need a cost breakdown. Now, if I were to buy the car and then all of a sudden they hit me up a month later, like, hey, now you owe a little bit more. And then a year later, hey, you owe this now. Okay, well, now I'm going to want a cost breakdown, right? But that's obviously not the case, right? Well, that's basically how the whole life policy works when it comes to not seeing those costs. So I just want to break that down really quick, because that is a point of contention sometimes with when it comes to transparency of these illustrations. But back to what Ben is saying here, there's no hidden costs inside of like an IUL illustration. The costs are broken down. With that said, you do need to know what you're looking at. Could there be some fine print and stuff and things that aren't explained very well when it comes to cost? Absolutely. But the costs are usually broken down on the illustration.
An IUL, which is basically something you could think of like a savings account, but has an insurance component attached to it that you must spend money on. Okay. The problem is,
see, that actually described a whole life policy. I would consider a whole life policy a savings account with an insurance cost to it, not an IUL. I think of an IUL as more of an investment alternative, whereas whole life insurance is a savings alternative. Very big difference there.
Is if that insurance cost is hidden to you. The second problem is that IULs tend to only get 4 to 6% in annual returns, which is pretty low. The third.
Okay, so that's interesting because that's actually what whole life policies typically do. Conservatively, also depending on the company, how you design the policy, what type of product you get, how you fund it. The typical range of the net internal rate of return after costs, fees, expenses, etc., in a whole life policy is going to be around 3.5%, maybe upwards of 5%. That's pretty typical. Okay. Now, I will agree with Ben that most IULs are probably going to do in that range of 4 to 6%. Not this 8 to 10% compound growth that I see some agents talking about. It's absolutely insane. There's other influencers out there that, when designed correctly, an IUL might do like between 5 to 7% average. But either way, to me, that's not enough above a whole life policy that to warrant the additional risk that I'm taking. That part is totally up to you. But it's just interesting how he's trying to break down IUL because of its internal rate of return, 4 to 6%, when that's actually what whole life policies do, net after cost. Now, one last thing I want to say about this, though, guys, is sometimes we get so fixated on rate of return, especially when it comes to life insurance, where we have to remember that these whole life policies, these are savings alternatives, right? We're not comparing them to investments. They are safe assets. Okay. And so to compare them to, the stock market or a mutual fund or something like that, just doesn't really make sense. Okay. But also, it's not why we set them up. Are we really setting something up to make 4% or 5%? Not really. To me, that's a bonus. That's a really good place to store capital. From the perspective of being a safe asset, I think 4% tax-free compound growth for life is actually really good. That's like a high-yield savings account with massive tax advantages with a death benefit on top of it. I'm going to take that safe asset all day long, and I can use the money to take advantage of wealth-building opportunities like I normally would. Sign me up all day long, and that's what I've been doing over the last 3 years. But I didn't start the policy to get 4%, okay? With that said, you'd be amazed at what 4% can turn into when it's uninterrupted over 30, 40 years. I did an entire video on that as well. Let me know if you want it. All right, but just remember, we're not setting these things up for internal rate of return. Expect to get 3.5% to 5% net in the whole life policy, depending on how you set it up. Okay. I just thought it was interesting though that he's breaking down IUL, saying it's not good because it only gets 4 to 6% when that's usually what whole life does.
Third problem with IULs to bank infinitely is that you have to borrow directly from them, and it stops the growth of your cash in there. I don't do that. I let my cash keep growing and I borrow against it. So we're going to break this down. The next thing that
okay, so what he just said, where you borrow against it. Actually, you know what? Let me back up here just a little bit. Let's get the full statement here.
IULs tend to only get 4 to 6% in annual returns, which is pretty low. The third problem with IULs to bank infinitely is that you have to borrow directly from them, and it stops the growth of your cash in there.
Okay, So this is the first half. Well, there's a lot of half truths, but the first major half truth about IUL, where I'm going to defend IUL here for a minute, just because I want you guys to have the facts. All right. So what he's talking about is what's called a wash loan. Now, what he's not telling you is that there's another option. There's another way to borrow against an IUL, and that's a participating loan. What he's talking about is a wash loan, which basically, if you take a wash loan, it means that from the perspective of what he's talking about, when you take that wash loan, that amount of money is no longer earning interest in the policy. Okay. And it's a wash loan because let's say you borrow at 3%. Well, the life insurance company is going to credit you 3%. So you're paying zero. It's a wash. Okay. But that means that that money that you borrowed is not earning interest. So for example, if you were to get, let's say, an 8% interest credit that year in your IUL, but you have half of your cash value borrowed out in a wash loan, well, that half is not going to earn the 8%. That's what he's talking about. Okay. And there's reasons why you would do that, why you would not do that. It depends on where you're at in your wealth building journey and what you're doing. But there is another option called that does allow you to get the interest credit on the full amount of cash value. It's called a participating loan. Now, the downside to that is if you have a zero interest credit year in your IUL, you're still going to be on the hook for that, let's call it 5%, 4 or 5% interest costs. Okay. Even though your policy is not growing that year because you got a 0%. However, let's say you get that 8%. Now you're getting the 8% on the full amount of your cash value. Okay. He doesn't tell you that. He's only telling you half the story. Now, that still doesn't mean to use IUL for infinite banking, but I want to make that clear that you typically have a wash loan option and you have a participating loan option when it comes to borrowing against an IUL. Keep that in mind. All right, let's continue.
I don't do that. I let my cash keep growing and I borrow against it. So we're going to break this down. The next thing that you need to know is that how to do infinite banking effectively is with what is called an institutional grade, high early cash value, dividend paying whole life policy, or for short, a HEC-V life policy. You do not want to use Primerica or Prime America, whatever it's called, or an inferior grade company. You want to work.
Okay, so let's talk about that really quick. So institutional grade whole life policy, I mean, the way I translate that or understand it is you want to make sure you're getting your policy with a mutually owned life insurance company that has a really good Comdex score, for example. So like the companies I work with have Comdex scores of like 95 or 96. Comdex score is basically a combination of different ratings from rating agencies, and it represents the strength and the financial strength and stability of that company. So you want the company that you're getting your policy from to have a really, really good like something like a Comdex score, just really high institutional grade. We'll agree with that. Okay. And then what else did he say? Hang on one second. Institutional grade policy. Oh, come on. What is it? Let's back up.
In other words, higher or as high as the United States.
Oh, that's right. He talked about the HEC-V, high early cash value. So it's just to be clear. So like HEC-V, I think what he's talking about is a specific product with Mass Mutual, which is like the biggest mutually owned life insurance company. And it's a specific product, but you don't have to buy that particular product in order to set up a high early cash value whole life policy. So for example, I have my policies with my first policy with Lafayette and One America. They don't, they might have something similar to a HEC-V policy, but you don't need that specific product in order to set this up. I just want to be clear on that. But he is correct in this, that you want to set up your policy with these mutually owned life insurance companies that have been around for 120, 150 years, never missed a dividend payment. They're some of the strongest, financially strongest companies in the world, far superior than banks. So that part we are in agreement with. Let's see what is next here.
Banking. In other words, higher or as high as work with a company that has an A+ grade credit ranking. In other words, higher or as high as the United States government or the U.S. Treasury. Now, the next thing that you must know is
at this point, I think these life insurance companies are rated higher than the U.S. government at this point, because U.S. government has been rated down. These life insurance companies continue to grow. So I think that's interesting.
That this concept and these companies are older than Bank of America, Wells Fargo, and Chase. And the real truth is that you should be making 9 to 11, sometimes 12% per year on your money insured before you do
Okay, this is where we're really going to start to have a problem.
anything else. Let's simplify it. Step one is you want to get a Heck V life policy. I'm going to tell you who I use, what I do, how I work with it, how you can get access to that later in this video. But let's just explain some math here. You can get a high yield savings account growing at 4, 5, 6%. An average savings account grows at less than 0.5%. What I get is two things. I have what's called a guaranteed return, which is 2 to 4% minus 4%. You got to go through an underwriting process and see what you get. But let's just use my example. I get 4%. And then I have what's called a non-guaranteed dividend. This dividend comes to me tax-free. The company I use has been paying a dividend no less than 6% for the past 50 years. So I've got 4% here, and then I have a 6% dividend over here. Combined, what is that? It's 10%. Now this.
Oh my God. All right. That's where you really lose me, man. That, guys, that is not how dividend paying whole life insurance works. Okay. You are not earning 10% in a whole life policy. You don't combine, you don't add the guaranteed rate of return and the dividend to get a total return for the policy. That is not how it works, guys. The dividend, so in his example, the 6% dividend, the guaranteed return is part of that dividend. So if you have a 6% dividend and a guaranteed 4%, the spread, the difference there is the surplus that the company returns to, that distributes to its policyholders in the form of a dividend. After cost, expenses, mortality expenses, et cetera. So that's another thing. The dividend rate, that's just a gross number. Okay, that's not net. That is gross before the company's expenses. But those two things are one and the same. Okay, so you have a 4% guaranteed rate of return. You get a 2% surplus. That equals the dividend. You do not get both. Okay. I just, like, when I heard that, I was like, are you serious? That is not how dividend paying whole life insurance works. And if you have a policy like that, that's actually earning 10%, sign me up. Let me know where that's at. But that is not going to happen, guys. And that's where this video just really kind of set me off a little bit, because that creates such a wildly unrealistic expectation of what these products are going to do. You're talking about averaging better than the stock market in a life insurance policy. No, never going to happen. That's just not how it works. Now, the other thing I want to break down too, to make sure you guys understand, is the difference in that guaranteed rate of return. It's going to come down to the company and the type of product that you purchase as well. It's not so much the underwriting process. Now, you do have to qualify. You do have to go through an underwriting process in order to qualify for the product, but that doesn't typically change the guaranteed rate of return within that policy. It just depends on what type of policy you get. Some will have 2%, some will have 3%, some will have 4%. And obviously, there's no free lunch when it comes to life insurance. So if you're getting something on the front end, you're probably giving something up on the back end. So that's why you want to analyze these different options very closely to make sure you're getting the right policy. Okay. But yeah, here's the thing. Every whole life policy with a mutually owned company that's participating, that is guaranteed to grow every single year. Even if it doesn't if you don't get the dividends, okay, for whatever reason, even though these companies have always paid it, you're guaranteed to grow by a certain percentage. Now, that's still a gross number. You're not going to see your policy grow by 4% every single year, at least in the beginning. Okay. We'll talk about that later. But you have the guaranteed rate of return. Then you have the surplus amount that creates the entire dividend itself. You're not going to earn 10% in a whole life policy, guys. I want to be very clear about that. Okay. So that's what's so frustrating about this, is because some people are going to see that and they're going to get hooked. Like, why wouldn't you? Use a whole life policy that earns 10%? That sounds amazing. Not going to happen. Right. And once you understand how the product actually works, right, and then you quickly realize, okay, yeah, that's just that's inaccurate information. Right. Anyways, let's continue.
My dividend is up to 6.4%. So I'm actually making 10.4% on my money. I don't
No, he's not.
buy tons of insurance. My insurance cost is literally $37 per value.
Okay, so what he's talking about there is policy design. Okay, and that is true where you can, I don't know, he's talking about $37, but you can lower when you're designing a policy for high cash value, you're going to lower your insurance costs, you're going to lower that base premium, and you're going to increase paid up additions, which shows up. And the majority of it shows up in cash value. So when you're setting up a high cash value policy, you're typically going to have more paid up additions than you will base premium. That's a policy design. That's policy design in a nutshell. So that's what he's talking about there.
4% growth, you have 6% growth. Again, mine's 6.4. I'm making 10.4%. I set this policy up so all of that growth, and when the dividend is paid back to me, it goes back into the cash value. So let's say I just start with $10,000 of cash value. I'm going to keep this in layman's terms, and I'm making 10%. That means I'm going to make $1,000 in the first year. Now I've got $11,000 of cash value that's growing for me, and then that's going to be $11,100, and then it's going to be $12,100 the next year. And that's
Nope. So putting aside the outrageous claim that you're getting 10% every single year, that's also not how a whole life policy grows, particularly in the beginning years. You're going to be negative in the first few years of your whole life policy. You know why? Because you're buying life insurance. There's a cost to that. Okay. So he's talking about, I want to give him the benefit of the doubt and just say that like he's probably just he's like simplifying the example there, but you have to make the example make sense as well and have it be compliant maybe too. Like, so in your first year of a whole life policy, let's say I have $10,000 of cash value and let's say it did grow by 10%. It's not, but let's say it did. You're still not going to have $11,000 of cash value after that dividend because you're negative in the first year. If I put $10,000 into a policy, I'm not going to have $10,000 of cash value available to me. If I really set it up for as much cash value as possible, I might have 9,000. Okay. But so with that said, it takes a few years to break even and then you're in the positive, right? That's when you have more cash value than what you've put in. Okay. But it's not as simple as I put 10,000 in, I get 10%, and now I have $11,000 of cash value. That is very, very, very misleading. You're going to take a hit in the first few years of the policy, guys. Now, that's not a bad thing. All right. I've done other videos on that, like why it's absolutely worth it to take a little bit of a hit in the beginning to set up your own private banking system here. It's worth it in the long run. Okay. But this type of content, man, again, crazy expectations. And then all of a sudden, if you're the person that puts in $10,000 and you don't have $10,000 and that wasn't made aware to you, and then your policy doesn't grow by 10%, what are you going to think? How's it going to make you feel? Well, it's going to make you feel ripped off, is how it made me feel. All right, so just be aware.
It's going to continue growing and compounding, like Einstein said, compound interest. Okay, and I'm going to keep stacking that up. That keeps growing at 10% plus for me, and then I get a line of credit against it. So step one, you get this policy. Step two, you get a line of credit against it. This is where IULs become inferior. You have an IUL growing at 6%, and then which stops the growth of this. You borrow against it, and then you lose the leverage. So what I do.
Okay, man, there's so many just misleading statements there. All right, so the first off, you can get a cash value line of credit against your whole life policy if you want. I've actually gotten quotes for this. It doesn't really make sense at the moment because one of my policies is lower than what I was quoted. My policy with One America, my policy loan interest rate is like 5.5%. The cash value line of credit quoted me at 6.25%. So that probably doesn't really make sense to do that. All right, but you can get a cash value line of credit with a bank and use your whole life, the cash value in your whole life policy as collateral for that. It's pretty cool. Sometimes it makes sense to do that. Sometimes it doesn't. It is what it is. You don't have to get a cash value line of credit though. You can just borrow against the policy. You don't have to set that up. All right. So keep that in mind. Sometimes it makes sense. Sometimes it doesn't. With IULs, again, I just want to reiterate, he's only talking about the wash loan, right? You're talking about losing leverage and stuff like that. Like you could take a participating loan against an IUL and still earn interest on all of the cash value, assuming you earn interest in that particular year. All right, let's continue.
I keep this growing and I get a line of credit against it at 4 to 6%. Okay. This is growing at 10.4%. No. I'm borrowing at 4, 5, 6%. So I'm already making money.
No, he's not. This is the positive arbitrage argument, guys. I'm like kind of sick and tired of this. Okay, positive arbitrage. We are not trying to get positive arbitrage in our policies. Can it happen every once in a while? Maybe. Meaning, if I get a 6% dividend, not taken to not taking into account that that's a gross number. Let's set that aside for a moment. But let's say I earn 6 and I borrow at 5. Okay, that's one point spread right there. Okay, I'm making positive arbitrage. That's rarely going to happen in the policy. That's not, because again, the dividend rate is a gross number. That's why you never set up a policy just based off the dividend rate, guys. It's kind of misleading, to be honest. All right, but he's talking about earning 10% over here, which is never going to happen, only borrowing at 4 to 6%. Hey, I'm already making money. Hey, why would you ever invest in anything else ever again? Why would you even borrow the money if you're just going to earn 10% uninterrupted tax-free for the rest of your life? It doesn't make any sense. All right, but that's not going to happen. We're not trying to get positive arbitrage within the policy. When we're using infinite banking for building wealth, we are trying to get positive arbitrage outside of the policy. Okay, now this is assuming that you're using the policy to build wealth. Let me give you an example. When I borrow against my policy to invest in real estate, to lend it on a piece of real estate, I'm going to borrow at roughly 6%, and then I'm going to lend that out to my investor at 13% plus a point. Okay, now I'm creating positive arbitrage. I'm not trying to get it in the policy. I'm trying to get it in what I do to build wealth. All right, so I borrow at 6, lend it out at 13. The banks do the same thing. When they pay us 1% on our savings account, and they lend it back to us for a car loan or a home loan at 4 to 5%, they're creating positive arbitrage, right? That's where that takes place. We're not getting it within the policy itself, though. That's just very, very misleading. It's not why we set up the policies, right? We're setting up the policies so that we can build wealth in multiple layers. We get lots of benefits from the policy itself, etc. Be very careful with that argument, okay?
Step is I go into hard asset, that cash flow, allow me to get all my money out and repeat the process, so I am generating an infinite return. And I'm going to dive deeper to that in a second, but that is where...
All right, so part of that is right, okay? There's lots of different ways to use the policy. Typically, I recommend using the policy to build wealth, either acquire an income-producing asset or partake in income-producing activities, okay? That's where you're going to build wealth in multiple places at once, all right? And when he's talking about buying the asset and then taking the money back out, this is a little bit more advanced. You don't have to do this. I've heard Mark Moss talk about this. I believe he implements it in his life as well. He talks about setting up the whole life policy. You borrow against it. You buy real estate, income, like cash flow producing real estate, right? You get a massive tax advantage for that. And then you can pull the money out at some point, depending on what your equity is. And you could take that and then acquire another income producing asset or pay off the policy loan. There's a couple different ways to do it. It's a little bit more advanced. You don't necessarily have to do that. But a great way to use the policy is to borrow against it to acquire more income producing assets, because now you're building wealth in multiple layers at once. All right.
The term infinite banking or becoming your own.
Yeah, the term infinite. I'm always careful with like infinite. Like obviously the infinite banking concept, that's a real thing. That's trademarked and all that stuff. All right. Infinite, you know, you can call it whatever you want. I really don't care what you call the strategy. I care about the strategy, not really the term. But the term, when we use the word infinite when it comes to making money, you want to be careful with that. Are you going to significantly increase your rates of return doing the strategy? Absolutely. The infinite part, I don't know. I mean, that's not really that big of a deal in my opinion, but just be careful with that word.
Bank comes into play. Let me know in the comments real quick, have you ever done infinite banking? Do you own an insurance policy? If so, what type? I am happy to argue in the comments.
Yeah, and I wish I had yours, because mine isn't earning 10%. I don't know anybody that's earning 10% in a whole life.
Because I can base all of this on literal fact. And as a matter of fact, the reason why so many advisors argue with me about this, and bear in mind, guys, I own a marketing company that works with hundreds of advisors. None of them do this. None of them know about it. I have met one of 30 individuals in the entire United States that is actually allowed to provide these types of institutional grade products to not institutions, to not banks, but to individuals just like you and me every single day. And I work directly with them. And I'll talk a little bit more about that in a second here.
Yeah. And, you know, it's good marketing. Like, he's making it sound more exclusive than it actually is. I mean, anybody can get this. Banks buy whole life insurance by the billions of dollars every single year. But, you know, as long as you know which company to go with and you know what you're doing, anybody can get access to these products, assuming that you qualify for it.
Step one, you got to get that policy. Step two, you get that line of credit. We help you just get both simultaneously so you don't have to go about it and do it yourself. Then the third thing is you need to go into assets, that cash flow, so you can use that cash flow to pay the line of credit back. So let's just make
that I agree with 100%, because sometimes people think that, oh, I've even seen content about this where they think, I don't have to pay the policy loan back because when I pass away, the death benefit will cover it, right? But that just remember the interest in on the policy loan is compounding against you. So if you don't at least pay the interest every single year, you could get into a lot of trouble and potentially lapse the policy. You do not want to do that. You wouldn't take a loan from a bank and not pay it back. So why would you borrow from your own banking system and not pay it back? That doesn't make any sense. So when you, for example, when I do my real estate deal, all right, I borrow against my policy. I lend it out on real estate. When that deal is done, I then take that money, I pay off the policy loan, and then anything left over is my net profit, right? But I'm always paying back the policy loan. That is, he's got that correct 100%. You get the policy, you borrow against it, acquire income producing assets. It's one of the best ways to do it. So I do agree with that.
Take a round even number, for example. You have $10,000 of cash value. You get a $10,000 line of credit, okay? Your line of credit is typically going to be 90 to 100% LTV, loan to value. So if you've got $10,000 of cash value here, you can get a $9,000 to $10,000 line of credit over here. And every year that this goes up, what I want you to do, and again, this is my not financial advice, is you level up the line of credit. This is $11,000 line of credit. This is $12,000 line of credit. And that's going to increase your leverage. When inflation is 2, 3, 4, or 7, 8%, like it's historically been in the last couple of years, and this is growing at 10, 11%, and you're borrowing at 4, you're hedging inflation and still making money, right? And again, these are fully insured beyond the FDIC limit of $250,000. These big insurance carriers have to keep as a balance equivalent to the cash value or death benefit. So if they ever went insolvent or just decided, hey, we're not going to be an insurance carrier anymore, we're going to open a McDonald's franchise or become a car dealership or something, they would have to pay that out to you. So it's
so that's a good point to bring up. I mean, I'm pretty sure that most of us can agree that FDIC insurance is a joke. I think they hold like 3% of their total obligations in reserve. So, it can handle a couple of banks failing, but you get more than a few, a couple of dozen, then all of a sudden, FDIC insurance becomes insolvent, right? Which is just kind of a joke. Whereas these mutually owned life insurance companies, so every state has an insurance like guarantee association, so that if a life insurance company were to go insolvent, that association would guarantee the death benefit claims, cash values, and things like that. All right, so it's not FDIC insurance, but it's a similar idea, probably better funded. But here's the other thing. I think I alluded to this earlier. These mutually owned life insurance companies are some of the most financially stable and strong companies on the planet. They don't take anywhere near the amount of risk with their reserves and money, et cetera, as banks do. So they're actually legally obligated to make conservative style investments in their general fund. They can't gamble huge amounts of money in the stock market and these CDOs, mortgage-backed securities, and stuff. Like, they do have mortgage-backed securities, but they're not leveraging it 50 to 1 like banks did back in 2008 and stuff like that. Like, you'd be hard pressed to find a mutually owned life insurance company that's gone insolvent compared to the number of banks that have gone insolvent over the last 100 years. So from a financial stability standpoint, you just really can't beat mutually owned life insurance companies. It's why I have the majority of my capital and savings in these policies. I have a little bit of money in the bank to cover expenses, but these companies are far more stable than banks, and we get so many more benefits by storing our capital into these policies. So we're going to go ahead and start to wrap up. I think here he's going to start talking about like different investments. Let's see here, which it's not really the point of this video.
FDIC insured, all right? It is literally what the banks use. That's what I do here, okay? So we've got all that. Now we need to go into assets that cash flow. I prefer real estate and I prefer oil. I'm not talking.
Okay, so I'm going to go ahead and wrap up here. He's going to start talking about real estate and oil and all that stuff. Here's the problem with that is, like, there's so many half-truths and misinformation about the whole life policy. Like, how do I trust what you're saying about real estate and oil? All right, there's nothing necessarily wrong with real estate or oil or IULs or whole life, right? They're just products and strategies. Like, they just are what they are, all right? I learned from Garrett Gunderson that the risk isn't in the investment, so to speak, it's the investor. Like, are you investing in something that you know, like, and understand? If not, you're injecting a lot more risk into something that otherwise wouldn't necessarily be very risky. So real estate lending, for example, that can be risky for a lot of people, but I've done the education. I've gotten mentorship, and I have mentors look over my deals and stuff like that. Like, I've got a pretty good understanding about how the process works. Therefore, I'm able to mitigate my risk quite a bit. With that said, if you don't do that and you lend to the wrong person, you could lose everything, right? And also the deals are secured by a mortgage, just like a bank would. Like, so I significantly reduce my risk by understanding the process, right? There's nothing necessarily risky about real estate, oil, whole life insurance, IULs, or any of that. Okay. Comes down to how much do you understand what you're putting your money into? All right. But I was saying, like, he's so wrong about whole life insurance and half truths about IUL. How do we trust what you're about to say about these investments? Now, what I will say again, you need to figure out what your investor DNA is. What are you comfortable using your policy for? Because here's the thing, when you borrow against your policy, you are introducing risk into the wealth building process, because now you're taking on leverage, you're taking on debt. All right, you're taking a very safe asset and you're injecting a little bit of risk into that process. Okay. But that doesn't mean you can't significantly reduce that risk by understanding what you're doing and having a game plan in place, having contingencies in place as well if something goes wrong with that deal. Also, not taking out, not borrowing against all of your cash value, leaving yourself some buffers, some space there, a buffer space, whatever. Okay, so anyways, I'll go ahead and wrap up with that. This video is long enough. I hope this was helpful. I think we talked about some really important aspects of infinite banking, dividend paying whole life insurance, a little bit about IUL. All right. So you can take that information, start to go down the rabbit hole yourself, do a little bit more research, figure out, is this, number one, is this strategy even for me? Okay. And if it is, do I want to use whole life insurance or do I want to use IUL? Or maybe I don't want to do either one of them. Okay. But you have to understand how these things actually work, not these massive misrepresentations about whole life getting 10%. I mean, guys, does that sound realistic? Like, do you really think you're getting at 10% every year in a life insurance policy? You're going to make more than the average rate of return of the stock market? I mean, let's use a little bit of common sense here. Okay. So just be careful out there, guys. If you want help with any of this, I'll have some links down below. I've got a free infinite banking masterclass you can check out, and then you can book an appointment with myself or my team if you want to go through this, see if it's a good fit for you, because it is a really powerful strategy, but it does have to be a good fit. All right. Hope you guys are crushing it, and I will talk to you in the next one. To your success. Matty S is out.